P. Swapna, Department of Management Studies, K.B.N College, Vijayawada. Today I am going to present a topic of capital budgeting decisions, payback period and accounting rate of return methods. So first of all, we should know what is a capital budgeting. The capital budgeting is an investment decision of a firm are generally known as a capital budgeting or capital budgeting expenditure decisions. So every organization, capital budgeting concept is very important. And capital budgeting concept decisions may be defined as the firm's decisions. And also it's called as an investment decisions and concentrating on the main for the capital budgeting concept is a long term of assets decisions making. And the organization is taking care of how we have to manage the financial resources, especially for the long-term assets, and how we have to anticipate of this expenditure for the flow and different aspects we have to maintain of these things. It is involves the currently outlines of the series of outlines of the cash resources for the how the cash resources we are spending to the organization and how it is a getting of a returns on the capital assets. And these are the topics we are going to discuss. First of all, what is capital budgeting features? Capital budgeting features are explained exchanging of current funds for the future benefit. As an investment decision, investment definition itself says that sacrificing of a present value for the future benefit. That is an investment. So we are sacrificing whatever the cash resources with us that we are sacrificing for the certain amount of benefit for the future. That is a investment. So this capital budgeting also deals with the funds are investing for the long-term assets which is given the benefits of the organization development. And another one is other important feature of the benefit will be accrue over the series of the years. Whatever the capital decisions we are taken, that will be influenced in the future future years also. So that's why we should be take care of the while taking of these investment decisions and capital decisions. There is a relatively high degree of the risk of involvement because of any wrong decisions. It is an impacting of the company future, and also it is an impacting of the organization future financial aspects. So there is a relatively long period between the initial outlay and the anticipated returns. So here is a capital budgeting is a concept is discussing between the initial how we are taking the decisions of the capital budgeting expenditures for the especially for the long run of an assets, and it is an giving it should be an anticipate that assets should be an great returns. That is our main feature is a concentrating the capital budgeting. So now we can discuss about what is the importance of capital budgeting decisions. The capital budgeting decisions are important because of the flow of the reasons. The first reason is the influencing the growth of the organization. So it is an organization growth is in a very impacted to the capital budgeting decisions. And another one is a substantial expenditure. So because of the capital expenditure is in the long run assets expenditures, we are concentrating or using of these funds for the long term purchasing of an asset. So that way it is a substantial expenditures. And another one is in a long term period. So their effect of the decisions will be felt over the long period of time. They have two long term consequences influencing the rate of the growth of the firm. That is a main impact of this. And another one already I told you the capital budgeting decisions are more risky because of it will be impacted on years by year. So that's why we have to take care of the while taking of this capital budgeting decisions. And irreversible. So another point is irreversible. So because once we are taken of any long term asset decisions, we cannot be get back or we cannot be changed immediately. That impact will be and go on for the long run of the project or organization. So complexity because of we know we cannot be, it is not the short term of decision, it is a long term of decision. That's why it is a long term assets decision. That's why it will be an impacted more. And next one we can know about the what are the types of investment decisions, that different ways of classifying of investment decisions. The first decision is an expansion of the organization. So if you any organization wanted to expand for the turnover way, or we are establishing any branches or something, that we have to take any capital budgeting decisions, that is included by the investment decision itself. And another one is in a diversification. If any organization already existed, they are in manufacturing one type of commodities, that they want to be go for the another line of product line also they want to go, then they have to take of use capital. So that type of decisions also include in this capital budgeting decisions. The replacement of modernization. So any organization already established, they are going with some technicality and some structural organization procedure is going on, that if they want to modify it and they want to upgrade of their organization structuring or technology or any other aspects, they want to need capital decisions. And the last and foremost important one is research and development. So every organization, they have a research and development wing is there. So now the capital budgeting decisions or investment decisions play the vital role of the research and development, because the organization wanted to any future of nearby, they want to diversify of their funds, or they want to be establish a new firm or a new product line, they have to conduct a research. So that's why they have to spend a lot of financial resources for this purpose. So these are the major types of investment decisions. Another classification is we can say that the mutually exclusive investments. So any organization, they wanted to be bifurcate of their funds into different multiple ways, then this capital decisions and investment decisions is play the vital role. And another one is an independent investments. The organization not be collaborating of any other funds, they want to be go for the one way of a funding, like an debt or an equity or in a banking, these type of debt and equity if you want to go, then such type of things they have to take a decisions about this capital decisions. And contingent of dependent investment. So we have to think about, we are investing the long run of capital decisions, that's why we have to take care of whether this decision is in the long run, how much it will be sustainable, how much it will be get the return, that we have to keep in mind. So these are the things of types of investment decisions. One is a different way of classification and another one is another classifications. Next we can go for the capital budgeting process. So how it will be in a work. So first of all, classification or capital budgeting process will go on first identifying the investment proposals. Investment proposal identification, we have multiple options are available in the markets. So for example, debt collection or an equity. So debt means we have a lot of capital avenues or investment avenues are available, like bankers and venture capitalists or indigenous bankers or shareholders or partners and all these people. And another one is another avenue is an equity market, like a shares, debentures, and these are the a lot of avenues are available here. So identify of the best alternative. Best alternative means which we can be spent of lesser cost of capital and more utilization. That is a main organization should be concentrate. Another one is screening the proposal. First of all, you have to identify the avenues of investment. After that, we have to screen it, which one is going to give the better choice for their organization, because every organization have their separate identity, their separate financial source and financial features also, different financial features also. That's why according to their organization nature of financial feasibility, they have to screen their investment proposal, which one is a better one. And another one is an estimation of the cash flows. So estimation of cash flows means we have to estimate the how much of the funds we can acquire and how much of the fund flow is freely we can accommodate. And another one is how the cash flows are and we get back of returns. So on every organization, how much of the expenditure we are spending, how much of the revenue generating, both the concept is very important. We have to keep in mind while taking off the capital budgeting decisions, we have to estimate what are the estimated cash flows and that we have to think before. And that next one, we have to go for the evaluation of proposals. Whatever the avenues we are identified, whatever the avenue we are screened, that we can analyze it of the cash flows, and based on the nature of the financial returns and nature of the organization financial aspects, we have to evaluate the proposal. And last one, we have to take care of the which priority base we are taken, or which capital decisions we are taken. That is a fixing of the priorities. So that is a point of the capital budgeting process. And finally, approval, the preparation of the capital expenditure budget. So we have to finalize of one aspect or a proposal, then we have to prepare for the capital expenditure manner. So the next one is implementing the proposals. We have to ascertain the project, and that we have to implement that proposal. So lastly, we have to take care of the performance review of whatever the decision we are taken, which investment avenue we are taken, that avenue we are followed, or proposal we are taken care of chosen, that we have to review once again the final way. So the next important thing is in this aspect is the methods of capital budgeting. The capital budgeting, we have two methods are there. One is a traditional method, another one is a time adjusted method of that called as a discounting method also. So traditional method, first of all we can discuss within a traditional method. Traditional method we can bifurcate on the two ways. Today we are only discussing within a traditional method only. So the first one is in a payback period method and accounting rate of return method. These two methods is so popular, most of the companies are following these two methods. Let's discuss within a payback period method, or a time adjusted method, or discounting method. So, and another one is a non-discounting method, is a time adjusted method, is a net present value method. We can call it as an NPV method, NPVV method, and another one is an internal rate of method. So IRR. So these both are familiarly known as NPV method and IRR method, and last one is a profitability index. So they can call it as a PI method. So these are the two types of methods. One is a discounting method, another one is non-discounting method. So today we only discuss with a traditional method, that means a discounting method. In that, first one is a payback period method. The number of years required to what is payback period? So here is a payback period is the number of years required to recover the original cash outlay invested in the project. So any project, first of all we should take care, any organization, if the proposal was came, they will be take care of two types of analysis. First one is a financial feasibility, second one is a technically feasibility. So first one is technically feasible or not. So technically feasible or not is a technical people will be expertise to analyze of that project should be technically we can be do or not. And another one, they after getting of an approval of the technical people, we will next send to that proposal, that project to the financial feasibility department or financial viability department. The financial department will be examine that project and evaluate based on the capital budgeting tools they are utilized, and they will be find whether this project is a financially viable or not. If the financially viable, then only the project will be accepted. So if the financially it is not be viable, if that project is a technically approval, even though they cannot be take care or they cannot be proceed next step. So they will be stopped there only. So the financial viability is very important. So how we have to financial viability we will examine. The only method is capital budgeting methods. The capital budgeting methods means in that very popularly and very easily we can calculate. The first method is a payback period method. What is the payback period method? The title itself it is saying that payback period. So whatever the initial investment we are invested, that organization, how much of time to take to recover of that capital or an expenditure get back, that is called as a payback period method. It means the number of years required to recover the original cash outlay to the invested for the particular project. So for example, the formula is the payback period is initial investment by constant annual cash flows, or so whatever the initial investment we are spent for the particular project, that amount we can be divided by constant annual cash flow, how much of a cash flow we are put. So that is the formula. So come to the point of, in case of an unequal cash inflows are there, it means in every year we are not spending the cash inflows in the same way. So different cash inflows we are using, then we can say it as an payback period is found out by the accumulating cash inflows until the cash flows in equal to the initial cash outlay. So what we do, if the cash inflows are not equal to every year, it is a different cash inflows if we use, we have to calculate all the cash inflows, how many years the cash inflows are equal to the cash outlay, initial investment. That period we can calculate, that period itself is says that payback period. So here the calculation of a capital budgeting method is says that your capital, how much of years will take to get back of your capital back. That it is an answer or a calculation is based on or give the result of periods or years. So that's why this method is in a very easy. So accepting rule, when we can accept this proposal. So the shorter the payback period, the more desirable is the project when they will be approval of the project. The first one, which project is take a lesser time. So generally specific the maximum acceptable payback period is. So when we can be get a very a short span, if you take, then only the project will be accepted. For example, if you take of 10,000 every year you are spending, your capital is you are spent for the 10 years, every year you are spent for the 10,000 rupees. So it will take off on 10 years. So the inflow of the cash, it means after you are spending of that, whatever the return you are getting every year, you are getting the amount of 20,000 per year. So it is in 10 years you are spending of 1 lakh rupee, 10,000 means if you take getting back of return is 20,000 every year. So then it will be take care of 5 years is a get back of your capital back. So compared to this one, another project is take off on 10 years. The A project is taken 5 years to get back of their capital, and B project is take off on 10 years of time to get back of the capital. Then the proposal will be accepted, which is having a lesser period of time. It means A project will be acceptable. So that is the payback period calculations. So another one is a simple understanding and easy why this payback period is very popular. Because the formula is very simple, we can calculate, only we need cash outflow and cash inflows. And based on the cash outflows and inflows, we can easily calculate. It is a very simple to understand or calculate. So another one is a cost less than the other method. So here is a no discounting rates we are using. We are not considering any time adjustments. And another one, it is a rough and ready method to dealing with the risk. So we can be easily calculate before starting of any accepting of proposals, we can easily be accepted. So another one is it reduce the risk of the loss through the possible of an absolvency. So it is a give the full picture about that. Before that we can be cancelled, or before that we can be accepting of the proposal, we should be take care of that. And another one is a sustainability for the firm having a shortage of the cash liquidity problems. So we can be know how long of time will take care of our capital will be get back. So we have an idea and we have a picture about that, how much of time will take I can get back of my capital back. Then they can, company can be decide to liquidity, they can maintain the good liquidity position. And another one is that they can be diversify their capital in very soon, very short span if this method is implemented. So what are the limitations of this one? So what are the drawbacks of a payback period? It is a fail to consider the time value of the money. So because any organization, time is a very precious thing. The capital resources or funds must be based on the time based. So here the payback period is totally ignoring the time adjustment. So that is a drawback. It is ignoring the cash flows beyond the payback. So here after payback period is completed, it means we can estimate it, how long we will get back of our capital. After that what? No calculation, no other information they are not provided of that formula. That is another drawback. So next one is it does not consider the cost of capital, which is an implement factor of making sound investment decision. So in a developing country like India, the financial resources are very scarcity, and moreover the scarce resources are very costly. The capital, it means an investment we are purchasing for the paying of the money. So that's why it is a cost of capital is a more important and calculating element. But in this payback period, we are ignoring the what of the cost of capital was happen. That was an, purely eliminated. So that's why this is not some of people will say that this is not give the full picture about that soundness of the organization. So determining of a minimum acceptable payback period is a subject to decision. Here is a payback period means we can accepting the proposal or a project which one have the minimum time to take. We are getting of more return, then we can easily accept the proposal. But accepting of the proposal, not only we are only considering the period time only. We are not considering the other factors which is very important. Even of not technical issues, okay, we cannot be considered, but other financial matters also influence. But this payback period method is ignored that one. So these are the limitations of it, and it is a measure of project proposal recovery, not profitable. So sometimes the project will be accepted only the criteria of how long we will be get back of our capital. We are not be consider, we are not be taken care of the profitability. So that is also in one of the drawback. So the popular payback method is because of the following reason. So why it is? It is very simple, and the company have a more favorable short run of effects of EPS, earning per share, is because of whatever the capital we are recovering, that morely influencing earning per share is the most important one. So the riskiness of the project can be tracked by having a short payback period. We can immediately we can assess that we no need of a longer calculations or any information. Very simple information we can be calculate this payback period. And emphasizing of payback period is on the early recovery of the investment, thereby given by the insight into the liquidity of the project. So this is a very good to why, because of it will shows that how much of liquidity we have. That is a popularity of this one. And another one, the traditional method is an accounting rate of return method. The accounting rate of return method, we can call it as an ARR. It is a financial metric used by the capital budgeting to assess an investment profitability by comparing its an average annual profit to its an average investment. Here is a accounting rate of return. So here the title itself is says that rate of return, how much of return we are getting back of our using capital. That is a main thing. Here the profitability of comparing of an average annual profit. So average investment expressed as a percentage. It is in a simple method of evaluating the project viability, but does not account for the time value of money or cash flow. So here this method also ignoring the time value of money, because this is a non-discounting factor method. So accounting rate of return, we payback period is a period we can explain, and here is a profitability percentage way this will be explained. So it is to provide the quick snapshot to the compare of a potential earning of a different investment options. If we have a different of an options proposals are there, in that this method is very good to choosing of the best alternative. The company will be in a typical proceed within a project within a calculate ARR is a greater than it is a required to rate of return. It means minimum acceptability of profitable percentage. Which project we can accept, which percentage is in a very high. So ARR formula is an average annual profit by initial investment into 100. So this expression ARR will be express on the percentage manner. So this is a formula. So here what are the pros and cons of the ARR method? So it is very easy to calculate or understand. It's providing quick initial assess of the project availability. This is a plus point of this method. So negative is it is in a simple method that ignoring the time value of money, whatever the payback period also have the same thing, money, and only accounting profit only, not for the cash flows. Here is what we are considering only in accounting returns only we are calculating, not with the cash flows. This can be make it as a less suitable of the large and long term capital investment. It is not be suggestible for the organization at a long run taking of decisions. So, and limitations does not consider the time value of the money, which can be misleading for the long term projects. If any organization have a long term capital budgeting decisions, if we take, this is not be suggestible method. The focus of slowly and accounting profit or ignoring the cash flows, already we told you, so it is in a very focusing only on the accounting profits only, not for the cash flows and all. It can be afforded on a different accounting policies such as the depreciation method. So because of a very key role is played the depreciation method, so it is not accounting methods, it is one of the depreciation method also there, but it is ignoring that. May not be accurately reflecting the true profitability, because it is an overlooked factor like risk and initiation and opportunity in these three, and cost. So other one, while ARR is a useful tool for the quick overview of the profitability. It is given a very quick, but it is not taken consideration of the very long period. It is recommended to use it is in a conjunction with the other investment evaluation techniques such as net present value method. It means an MPV method or internal rate of return for the more comprehensive analysis, especially for the long term complex investment decisions. So okay, these are the points of that. So recap of today we are discussed about what is investment decisions, on that capital budgeting methods and capital budgeting decisions, and capital budgeting concepts, traditional method and time value of methods, and traditional methods or we are discussed very detailedly payback period and accounting rate of return methods. Thank you.